Okay, so now we can continue discussing this disclosure of amounts, right? So what amounts must be disclosed for the reporting period? You would need to disclose revenue that is recognized for that reporting period from contracts with customers. So we've discussed that already, right? You would then recognize them separately for the different sources of revenue. And for example, this would be if the entity's ordinary business is the sale of picture frames and accessories. However, other revenue earned by the entity is the provision of interior decorating services and window washing services, then such revenue belong to different revenue streams, and then they must be shown separately, depending on how significant the different streams are for the entity. So these revenue stream amounts then must be disaggregated based on their characteristics. But that's not all. Paragraph 113 still goes on to indicate that any impairment losses recognized in terms of IFRS 9 must be shown separately for each of the underlying revenue stream or contracts. So impairment loss on one contract asset arising from one revenue stream must be shown separately to any impairment loss on another contract asset. This disclosure is not required is if the separate disclosure is already made in the statement of comprehensive income in terms of other standards. The standard then requires revenue to be disaggregated based on the different revenue categories like we mentioned, and to differentiate between these the nature, amount, and uncertainty evident from each of these revenue contracts should be understood and identified. What needs to be understood is the manner in which it is affected by economic factors. There's further guidance in paragraph B87 to B89 where you can choose, where you are given guidance in selecting the categories to disaggregate. Furthermore, the company shall disclose sufficient information to enable users of financial statements to understand the relationship between the disclosure of disaggregated revenue and revenue information that is disclosed for each reportable segment. So that is only obviously if that entity reports in terms of IFRS 8. Do they report reportable segments? If they do, then you need to relate how the disaggregated revenue relates to the different reportable segments. Okay, a nice example that illustrates all of this, and in a very simple manner, but also a very short example, is IE 41, illustrative example 41 in your IFRS Part B textbook. So it will be beneficial for you if you go through that example. Then we have paragraph 116 and 117, which discusses contract balances. Okay, so the required disclosure for contract balances in terms of these paragraphs, the opening and closing balances for receivables, contract assets, and liabilities from contracts with customers, if obviously they are not disclosed in terms of any other standard. Another aspect that these paragraphs want disclosure of is revenue recognized in the reporting period that was included in the contract liability balance at the beginning of the year. And now during the course of the year, that amount is now, it has met certain requirements and now can be recognized as revenue. You need to show those differences, those balances, and how they then move from contract liability to revenue. Similarly, revenue recognized in the reporting period from performance obligations satisfied or partially satisfied in the previous periods, for example, changes in the transaction price, so additional disclosures in the current reporting period is then required. So these now cover for the different amounts. Explain the timing of performance obligations satisfied versus the timing of payment and how these affect the related contract asset or liability balance. Again, the information and explanation will use qualitative information. So this is where amounts and the qualitative information can come together. So now let's say that there were significant changes in the contract asset or liability balances. Then what? So first you ask yourself, when did the change occur? So when did the change occur? The change had to have occurred in the current reporting period. Okay, and what should you disclose and what do you do about this? Well, you would essentially give qualitative and quantitative information so that users can gain an understanding of what needs. So examples of changes in the entity's balances of contract assets and liabilities would include changes due to business combinations. So an example of this, or a typical change, would be adjustments or changes made to the measure of revenue of the various reasons, such as changes in estimated transaction price, contract modification, variable consideration changes. All of those would be affected due to changes in a business combination. Another type of change would be your cumulative catch-up adjustments to revenue. So this is also now a form of revenue measure that affects the underlying contract asset or liability. And these could include adjustments arising from a change in the measure of progress. So maybe the contract term changed. Maybe the contract term is longer or the contract term is shorter. So where if you had revenue to be recognized equally over a 3-year period and that 3-year period becomes a 4-year period, obviously that changes your transaction price or the portion to be recognized in the current period. So all of these changes would then need to be disclosed. A change in an estimate of the transaction price, including any changes in the assessment of whether an estimate of the variable consideration is constrained or a contract is modified. Right, and in the same light, other changes would be if there's an impairment of a contract asset. So there will be indications of such an impairment. Then you need to describe these indications in the information provided. And then you would also then have to do the monetary calculation to see what is its effect on the amount of the contract asset recognized. A change in the time frame for a right to consideration to become unconditional. For example, when a contract asset can now be reclassified to a receivable. So something changed, maybe a condition needed to be met, and then that condition is now met. So you can then transfer that from contract asset to a receivable. You have now the right to receive it. A change in the time frame for a performance obligation to be satisfied, for instance, if you have a contract liability relating to the item at the beginning of the year, but during the year the obligation is satisfied, so it can now be transferred to revenue. So that's specific to performance obligation. What disclosure is then required specific for performance obligations is discussed in paragraph 119. So this paragraph is most important because it brings together the different aspects that need to be disclosed as they all arise from a performance obligation. An entity shall disclose information about its performance obligations in the contracts with customers, including a description of all of the following. So the first aspect is when the entity typically satisfies its performance obligations. And an example of this would be we expect, or the entity expects to satisfy the performance obligation, which is the sale of goods or the sale of window washing equipment, for instance, when it is delivered, because that is when control transfers. So this is the type of detail they want in these disclosures. Other examples would be, is it upon delivery or as services are rendered, so then over time or upon completion of the service. So when is the performance obligation satisfied, including when performance obligations are satisfied in a bill and hold transaction or arrangement. The significant payment terms, when payment is typically due, whether the contract has a significant finance component, whether the consideration amount is variable, whether the estimate of variable consideration is typically constrained, and more information about constrained variable considerations are given in paragraphs 56 to 58. Another aspect that they want disclosed in terms of performance obligations is the nature of the goods or services that are transferred, right? What is this? It's a good and it's a service. But more detail is now added in this paragraph of the statement, which is, are you facilitating this transfer of revenue as an agent? Or is the performance obligations to arrange for another party to transfer goods or services, what is your part as an entity in the transfer of these goods and the receipt of revenue? Do you receive commission revenue, or is it via the sale of products or the rendering of services? So that type of specific detail is needed here. And obligations, then we need to describe obligations for things such as returns, refunds, other similar obligations, and types of warranties. So remember, we discussed this in the previous slides where we discussed uncertainties. So these are all still obligations because we raised an expectation in the customers that, we're going to do this, so we need to create a warranty provision for this, and we need to describe the circumstances around it, what would conform to the policy of the entity to return goods and get a refund. So all of these need to be described in terms of this paragraph with more detail. The amounts related to these would usually affect your statement of comprehensive income and your statement of financial position for the related contract balances. However, remember that the qualitative information of not disclosed anywhere else would typically be in the accounting policy note. All of the amounts are normally disclosed in like your statement of comprehensive income and your statement of financial position, but the qualitative information is disclosed either in the revenue note, and if it's not separated from your accounting policy notes, but if it is separated, it would be found in the accounting policy notes, because that's where we give all of the company's policies and qualitative information.